Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today in the Econ Show, we want to talk with you about some key topics that we've been really following, and it's looking at those high-frequency data points, understanding what's happening within specific countries, but also as an aggregate to see, okay, well, where is the GDP going? Where are some of these leading indicators pointing towards? Then we're going to dig into some of the US data that's come out to understand, what does it mean? How is that going to impact us going forward? And then rounding out with employment and unemployment, and what does that mean as we go into spending, specifically through September and well into October. So just to kick it off, we want to talk about, again, the advanced economies, emerging markets, and then China. So here you can see the emerging markets are actually starting to get a relative bump higher, which is a positive to see. It means that we are seeing a bit more pull through of raw materials. We're starting to see a little bit more movement, and that's being reflected in the emerging market. Now, the ability to maintain that is going to be tough, just given that we have additional headwinds in advanced economies with some new COVID increases in Europe, some uncertainty within the US. But again, these are positive data points that we're starting to see really start to arise. And we can talk about which countries are really driving that in a little bit later during the segment. The one that we're starting to see a little bit of headwinds is on the advanced economy side, really driven a lot by South Korea, US, and some softness in Europe, specifically Spain. And those are things that are kind of weighing us down. Now, again, it's not a perfect science. We're always looking at things. Things are updating quickly. But again, it's starting to create a reweight, specifically on the Euro GDP side, where you're starting to see a little bit shifts down in terms of what the expectations are. Now, even though we're getting some of these benefits on the emerging market level, we're starting to see a lot of headwinds emerge in India, which is really not something that we think is going to quickly kind of work its way through, and is really also weighing on total oil demand, which we'll talk about during our OPEC segment. But the other thing is China. China continues to put out some mixed numbers where we get some positive news, but then we get some really negative news. And it really comes down to what is happening within China itself. And imports remain light, which again was more indicative of what is happening within the country. And we continue to see problems within the Yangtze River and the whole economic basin that's attached to, which again, even though we did get a bounce off the bottom, it's still going to be headwinds in terms of how much can they really stimulate going forward. And that really leads us into what is happening within the onshore bond defaults. So we're starting to see a bigger increase in defaults that started to really accelerate through 2018 and 2019. And you have to consider, when did stimulus really pick up? So China really aggressively issued fiscal and monetary stimulus at the end of 2016, and you saw that really carry through and then really kind of pare back and then peter off completely in 2018. Now, when they discontinued some things, but then they realized that they really had to kind of go a bit more aggressive, and you saw a big pickup in 2019 as we had the US-Chinese trade war remain a problem within the industrial sector. But even with a lot of these benefits, we're continuing to see additional bond defaults, even though the PBOC and the Chinese government has done a significant amount to try to stimulate the economy and try to keep things relatively stable. And just taking this to a perspective, we're going to look at the big four banks and understand, okay, well, what were their profits look like? What did things, and this came out over the weekend, and you saw some huge declines with the Commercial Bank of China, net profit down 11.4% in the first half, Chinese Construction Bank down 11%, Bank of China down 11.5%, Agriculture Bank down 10.4%. Now, the reason why this is important is because you're seeing the bad debt expense, and you're seeing more cash being held on the balance sheet. And even though the PBOC is trying to push that through, saying, no, you need to lend, you need to give forgiveness to some loans, you have to forgive or delay some interest payments, you have to work with these, and this is good. The inherent tools necessary just are being stressed to the breaking point. So the question is going to be, how much can they really push a lot of this liquidity through? And it always goes back to that, it sits at the PBOC balance sheet, and you're seeing additional special purpose bonds. But again, infrastructure is a problem, because even though we're seeing an increase in construction, what is that going to mean for the longevity of the project and actually paying it back? Because we continue to see headwinds based on bonds that were issued in 2016. And those were projects that, again, never really paid for themselves, had to be financed with tax revenue, and eventually were declared bankrupt. And these are the issues where we continue to look at and try to make heads or tails of, okay, well, China's telling us one thing, but then the actual data is showing something different, but then we're getting some additional headwinds here. So again, it's always a matter of trying to get as close to the bullseye as possible with what's happening in China. And that's when we shift to the factory recovery. So here you can see, just looking at the data that's come out, construction is back up again, coming back to the special purpose bonds, the push to get construction going, to really see that recovery. But the new export orders is where we continue to see those headwinds. And again, when we look at, and this is when we look at what's happening with exports, imports, and we talk about shipping overall, new export orders remain weak, because again, the emerging markets have recovered a bit more, but the advanced economies, who China has some of the biggest trade with, continues to struggle. And now, something that we're going to talk about in a different segment, the headwinds that are continuing to rise between China and India. And India was a big trade partner and has increased in terms of prominence of trade over the last 5 years, which is going to continue to weigh on that. Now, the other thing is manufacturing. Now, they came very aggressively off the bottom, but you see that things are starting to slow down and starting to normalize. And again, it comes down to the lack of ability to get those exports into the market. You're just not seeing that kind of recovery. But on the service side, we're starting to see a little bit of the opposite. So it's a tale of two cities here. And we think that the manufacturing issues are going to be more pronounced, especially as the flooding continues to be a problem. And some of these manufacturing facilities, and factories within the region continue to struggle to get to come back to normalcy, especially with the problems that we're seeing in the export market. Now, when we look at the steel industry PMI, I think it's important to understand what has happened within the steel side of the equation, because we see a lot of this in construction. We're seeing a lot of these positives, but we're seeing a breakdown in terms of steel industry data points. And the biggest one is new orders and new export orders. Those are two things that we're starting to see where you came hot off the bottom. All of a sudden, there was a big push through, and you saw it from April, then you saw May, June, and then July started to show, okay, well, maybe June was a blip. Maybe June, you're going to start to see something come back, and then July happened, and now you continue to see some of the slowdown. And it just means that you had this big ramp up, and now they're starting to pull from inventory. New export orders are coming down. So new orders are now following that. So you're seeing an additional slowdown, which should weigh on the future when we look into September and October PMIs, just based on kind of where the data points are and just where they sit in their total recovery levels. And this is why China remains problematic when we look at oil demand and we look at diesel demand and gasoline overall, because even though we're starting to see some of this recovery, you're starting to see some of these headwinds in steel, and employment remains a problem, which again speaks to imports, speaks to additional headwinds, which we're concerned about specifically in China itself. And now India is another one where we continue to see an increase in new COVID cases. New active cases continue to move higher. Lockdown index remains relatively kind of in this, let's call it 80 level. And the problem is you're continuing to see this ramp up. This is causing 22% declines in diesel demand. We're seeing 50% of the trucking fleet sidelined, or at least something in that ballpark, which again is just going to continue to weigh on just the India recovery, if you will. And again, this is oil demand, this is diesel demand, this is a normalcy. And when we look at global trade, this is going to continue to be a headwind. Now, with all of those comments being said, we continue to see the essentially emerging market debt that's denominated in U.S. dollars seeing, there's the yield had a big spike. There was some concerns about what was happening, but now you're starting to see a little bit of this loosen up. And what this just means is it's easier for emerging markets to borrow in U.S. dollar denominated debt, which kind of runs counterintuitive to where we've been at this point. But again, with the Fed talking as aggressively as they are about running above 2% inflation, worrying about the average instead of just the a 2% hard line, you're starting to see essentially investors say, okay, well, how do I find yield? Where do I get yield? Where can I actually make money? And you can see them moving back into some emerging markets, especially on the US dollar side, because, okay, well, if it's the US dollar denominated side, makes it a little bit cheaper. I don't have to worry about the US dollar fluctuations versus some of the local fiat currency, because even though we've seen the US dollar weaken, 96 fiat currencies have weakened further against it. So it's kind of thing where it's like, okay, well, the dollar's weakening, so you should see a benefit, but it's almost like they're all going down together. So that's why you're seeing some of these benefits as well. This is something to watch, because if you start to see this crack and drift higher, it means that there's going to be an issue at the local level when it comes to some of these markets trying to find actual capital. And that leads us into, well, what are some of the countries that are finding some of these problems? And here, this is the breakdown of the emerging market index to kind of pull it apart and understand what makes it up. And now India has seen this incline, but now, like this red line here, you're starting to see that roll over and it's starting to come back down, which is going to be a problem overall. But China has seen some recovery. Brazil has found some form of normalcy, and you're starting to see something similar through South Africa. So again, this is where you're starting to see a little bit of a shift higher, which is helping to kind of pull those emerging markets up. Now, China was broken out from that, so we're not going to really look at it. But even the bottom quartile, even though they're still struggling, they're still better than they were in July and as we got through August. So again, that's where we're starting to get some of that shift. India remains the biggest headwind when we consider kind of what's going to happen going forward. We think that India is already starting to roll over. It's really not picked up fully yet in the daily activity indicators, but you're starting to see that in terms of some of the new data points, and that's going to continue to roll over. So now as we look and shift and pull back out into, okay, well, what is happening in the developed economies? Here you can see that they're starting to see a little bit of a softness. Things are really kind of starting to roll back over. And it's really being driven not only by the U.S., but also Europe. And it comes down to, some of these resurgence of COVID in both Spain, France, and some spots in Germany, but those seem to have come under control. So the real focus at this point is really France, Spain, and Italy, which have seen an increase in some COVID cases and has resulted in a big slowdown. Japan has been something similar. Now, South Korea isn't on this specific chart, but South Korea has also experienced its own setback, which has also dragged down some of these indexes, which is something that we're going to talk about a little later. The U.S. is the one that is causing some of the biggest headwinds, because even though we're seeing some of this normalcy, we're really not getting back to where we should be, or at least back to some comfort levels. And we're going to talk about a little later some of the different data points, because we're getting some positive news in consumer goods in terms of purchases, durable goods. But again, that unemployment spending component remains a big headwind, especially based on how people feel about job security, and that really leads to how are they going to continue to spend and really drive the GDP growth, because the consumer is such a huge part of how does the U.S. GDP look, and those are things that we're going to evaluate as we go further through a lot of these different data points. And that really kind of rounds us out with what are the GDP forecasts. So when we look at the U.S. has gotten a little bit better because we have seen a little bit of an increase in terms of Fed data points, consumer buying, some PMI data. So you're starting to see a little bit of comfort to say, okay, well, maybe we will get a Q3 increase. And again, the big thing is going to be what happened in August and what's happening in September, that we've lost a lot of that fiscal support with the extension, with the lack of an extension on some of those unemployment benefits. The bigger problem is the euro area has actually been walked back. And the reason why we've seen some of the expectations for the Euro 2020 growth has weakened is really driven based on Spain and Italy, specifically Spain, which has seen additional headwinds come into the market, and their economy has weakened a bit more than expected. So that's one of the reasons why we've seen some of those slowdowns. Now, when we just look at this chart and understand, okay, well, 2020 into 2021, there's still people are still assuming that we're going to get a fairly robust recovery as we go into 2021. And the question's always going to come down to, is there a vaccine? Where do we sit in terms of total demand, in terms of comfort of movements and getting back to normal? And does work from home become more permanent? Are some of these jobs going to come back with a vaccine? Like, these are a lot of unknowns, and just based on where we sit and how we see the world, we're not comfortable in saying that we're really going to experience this kind of increase on a year-over-year basis. But again, we're always evaluating this to understand where are these shifts going, and especially as we saw the euro area data start to walk back and start to soften, we have to consider what is the export market doing. And the export market, while it did get a lot stronger in July into August, we're starting to see that softness kind of creep back in as we go into September, which again, we have to appreciate and really evaluate, well, why is that? And is it something that is a blip, or is it something that's going to be more sustainable and weigh on some of these numbers as we go forward, which is why it's so important to look at consumer purchases, consumer staples, which we're going to talk about in our next segment.